Ulta Beauty is down 13% today. We can see it is also down over the last 12 months. It's now trading at the mid to lower end of the 52-week range. So is this an undervalued, strong, high-quality company that we should consider for our portfolio? Let's take a deep dive today. We're going to take a look at the numbers. We're going to run through their top-line revenue growth as well as their bottom-line net income over the last few years. We'll also want to assess the health safety of this company, looking at their total cash versus their total debt. And we're also going to see how they're performing, not just over the last few years, but also versus some of their key competitors and those similar in the industry. We'll also look at the institutional ownership, see whether the institutions themselves are buying year on year, quarter on quarter. And we'll also discuss some notable sales that we have seen from insiders just over the last few weeks. As always, we will look at some of their financial metrics, their free cash flow, their sales growth, and a few others. And we will discuss why they have been crashing down today. We will also run them through the valuation model to get to the intrinsic value as well as our acceptable buy price, given our investor margin of safety, and look towards Wall Street to see what they are expecting as a price target over the next 12 months. So let's recap with their performance. So whilst they are down around 18% over the last 12 months, we can see if you have been a shareholder over the last 10 years, you would be up 395%. We can also note the forward PE does sit just over 19 with a market cap of 25 billion. Now, the reason why we did see this massive drop of double digits, in fact, today for this company was due to the fact that they have said that they do see slowdown in their numbers. Now, they did talk at the recent JPM Morgan retail conference, and essentially the CEO did mention that there was slowdown in their total category, whilst they were expecting this to be moderate. So a little bit of a worry whilst they did release their forward guidance. It does look like now, based on what the essential CEO is talking about, as he mentions here, that there is a slowdown, and therefore this will be shown in their latest quarterly earnings, which wasn't what investors wanted to see. They were very buoyant on the numbers that they did release and the forward guidance from the previous quarter. So something we will factor in when we do look at our numbers and our valuation later. In terms of the sales then, top line, what we can note is 7.4 billion in February 2020. At a minimum, we want 3 to 7% growth year on year. Now, this drop is justified due to COVID. They would have shut down their shops. Consumers wouldn't have been able to buy their favorite products. But we do see it did rebound strongly into 2022 and 23 and 24. So top line growth, in my opinion, does look healthy. We will look at the percentages shortly as well over the last 10 years. Bottom line, again, we do note the drop from February 20 to Jan 21, as we mentioned, due to the pandemic. Since then, though, it did rebound very nicely. And overall, both top line and bottom line at the minimum have increased over the last 5 years. So it does look to be healthy. In terms of the health of their balance sheet then, total cash versus total debt, 500 million of cash and short-term investments in 2020. The latest quarterly report, 767 million. So it has increased by around 50%. Does look fairly strong, especially when we do compare it to the total debt numerically and directionally. We can see, in fact, it has dropped, although very slightly, from 1.9 billion to 1.91. So something we can factor in when we do look at our net debt to EBITDA metrics, but overall the balance sheet doesn't look too bad. Now, we are comparing it to others in the other specialty retail industry. We have Tractor Supply, Dick's Sporting Goods, Bath & Body Works, and a few others that are very well known. Over the last year, though, we do see Ulta, one of the worst performing, down negative 18%. When we extend this to the last 5 years, in actual fact, they are still one of the worst performing. However, they are up 29%. We do see, though, a lot of other companies returning triple digits. One thing we would say, though, past performance doesn't effectively show us what the future performance will be, so do bear that in mind. But overall, they haven't had a great historical performance just over that 5-year period. In terms of institutional ownership, quite high at just over 90%. We see 5 billion worth of sales by the institutions over the last 12 months. The same period, we see around 50% more worth of buys, so institutions have been buying more than they have been selling. And we also note every quarter, Q1, Q2, bar Q3, in fact, institutions were buying more than they were selling. We don't have the full data yet for Q1 in 2024, but positive for investors to note that the latest quarter, Q4 of the data we have, institutions were buying a lot more than they were selling, and that also goes for the last 12 months on average. Now, just over the last few weeks, we have noted insider selling, in fact, on 3 different occasions by 3 different people. We have the director, the chief human resources officer, as well as the president and the COO himself. Now, we do note since they did sell, the share price has in fact plummeted negative 15%. But personally, it isn't necessarily a bearish signal. If we were to see insiders sell, we wouldn't say we should sell our shares straight away. Do bear in mind there are many reasons why they may sell, personal, financial, and a few others that we may not be privy to. But as always, being transparent, we can see the numbers here. Now, just before we look at the metrics, just to let you know, we have released our latest free weekly article. If you do want to gain access to any of these others, all completely free, do click on that pinned comment below. Now, in terms of free cash flow, that is what we will draw your attention to, although you can see the earnings as we do go along our review today. It is more susceptible to manipulation by management through accounting. So on the free cash flow, we do see some very strong growth, nearly 10 times over the last 10 years, but a little bit inconsistent, nonetheless moving in the right direction. And positive to note, 2025, FY25, in fact, they are expecting an increase to that free cash flow, so it is continuing to increase even in the future. In terms of sales growth, as we mentioned, 3 to 7% is really the minimum we want to see for these types of companies that are growing at a very rapid rate. And in fact, other than that COVID year, which is justified, they have been increasing their top line double digits every single year. Although we do note 2024 at 10% was one of the slower years out of that last 10-year period. In terms of numerically speaking, well, they have in fact more than tripled their top line, just under 4 times it, from 3.24 billion to 11.2, and even though they did start off with a very small number of shares outstanding at 64.7 million, they have been doing consistent share buybacks year on year, which is very positive to investors. That is returning excess cash, as they are essentially giving you more control or more of that ownership of the business, with those shares outstanding reducing. ROIC, very strong, very strong. In fact, I want to see a minimum of 10% just to give me faith that management are able to effectively allocate their capital. We're seeing here, other than that 2021 year, as we mentioned earlier, very strong across the board, pretty consistently between 30 to 45%. 2024 at 39% is very strong and attractive to potential investors. And operating margin, we do get a small sense of operational efficiency as they have increased their margins over the last 10 years. Looking healthy at the 15%, we want to see a minimum of 12%, ideally 16 or more. So the 15 to 16 over the last few years is looking positive. And the free cash flow margin at a minimum of 5%, which they have achieved nearly every single year. 9% again in FY24 is very positive. Net debt to EBITDA, again showing they have a very strong balance sheet, the earnings before the interest, tax, depreciation and amortization. And what this metric shows us is the number of years it would take the company to pay off all of their debt net of cash on hand. We see it reducing 0.49, and in fact FY25 expected to be there or thereabouts, showing that this company has a very strong balance sheet, and there weren't really any red flag indicators that we would pull out from this review so far. Now, in terms of the valuation, let's get into the numbers. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model we're looking at is the multiples valuation model, companies in a similar sector and size. Now, we have their P multiples, we get the average, we multiply that by the EPS of ULTA to get an intrinsic value, as we can see here, of well into the 500s, above the market value, showing a strong sign of undervaluation. Although do bear in mind, we don't look at any of these in isolation and conclude towards the end. The next model that we would typically use would be the dividend discount model. Now, they don't currently pay a dividend, so this one right now isn't relevant. So we move on to the DCF model. We have the free cash flow year on year. Average growth at 48%. We have gone a lot more conservative at 6%. Remember, this is lower than both analyst targets and management expectation, as well as the historical data. In conjunction with the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and then we get to their intrinsic value. Again, a second sign of undervaluation. So both models we've used today, we do see that undervaluation signal. And do remember, if you do click on that pinned comment below, you can grab a copy of this valuation model, so you can also get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those in your watch list. So margin of safety, as always, we always talk about the 10% starting point, and we do use that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. And then we pretty much keep going till it's near the current trading price, and we can see for today's episode, it is pretty much there at 20%, so up to $452 would give you a 20% MOS level based on our estimates and judgments. Now, in terms of Wall Street and their price expectations, well, as we can see, they have forecasted $589 over the next 12 months. So they see upside currently of 31%. They do believe there is some very strong upside with this company. Now, whilst it doesn't pay a dividend, it does look like the return of 31% in combination with the margin of safety of 20% does look like it could be a very good company to add to your portfolio. But as always, do let us know your thoughts in the comments below. Is this one you're considering? Is this one maybe you've had on your eye and is in your watch list? Or maybe purely for the fact it doesn't pay dividends, it isn't one you are willing to consider? As always, we are keen to hear your thoughts. Remember, if you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.